Hi value investors, welcome to my channel Value Investing Applied. Today I'm going to talk about the DCF, the discounted cash flow methodology to calculate the intrinsic value. So I will try to make it easier for you in this video because I will explain that formula from the beginning, from the very basics, explaining concepts like the present value, the future value, and in that way we could construct the formula in order to get the best picture, the best idea about this formula. And I'm sure that you will get that best idea that I'm looking for. Something really important would be to explain how the free cash flow is constructed, and that is something that I will do after the explanation of the enter formula. In that way, you will understand how the free cash flow is constructed, what is the main drivers, the main assumptions, and so forth. So, and at the end of the video, you will get an idea on how the current situation could influence our calculation of the intrinsic value. You see that according to the Federal Reserve is planning to rise interest rates for the next 2 years at least. So we need to really understand how that situation, how that scenario will affect our current valuations. Okay, so I will start from the beginning, and I hope that you really enjoy this, and of course you can put any comment in the boxes. And something really important would be that it is not a financial advice, it is just for educational purposes. So we will start. Okay, here we have, imagine that we are in the year 0, and then this is the year 1. Suppose that you have in your pockets $100 in your pocket, and then, well, you have many possibilities to keep those $100 for the next 2 years, this year and this year, or to put to work to you this money. I mean, there are lots of possibilities, like to invest in the stock markets, invest in fixed income securities, to invest in ETFs, in investment funds, you name it. Okay, so we will suppose that the R would be the average return of all those possibilities that you have to put to work for you this money. Okay, so what would be the return? What would be the return that you will get at the end of the year 1? Okay, you will get something like this. Okay, now this is your 100 plus a return. Okay, now this is what is called the future value. Okay, this is the present value. Okay, the present value of this number. What happens if you want to know what is the present value of this number? Well, you just want to put that money, 1 plus R, and just divide it by 1 plus R. Okay, and you will get the number that we got here. Okay, now the same idea, we could apply the same idea for longer periods. What happens if you have the same $100 in your pockets and you are expecting to get a better return just putting that money for a longer time? Now, what would be the number here, the returns that you will get, assuming that you have all the same possibilities that I mentioned previously? You have these possibilities of R, which is the return of all the average return of all the other possibilities. Now, what that would be that in the first year that would be 100 plus 1 plus R, but in the second you will get another return. I'm sorry, here you will get another return here. So you will take the 100 R, and you will get another return because we are in the second year. So that means that we have 1 plus R at exponent 2. Okay, so again, this is the present value and this is the future value. What happens if we need to know what is the present value of this? Well, we just take back this number and divide by 1 plus R at exponent 2, and you will get your present value from the beginning. Okay, so whenever we are in a year 1, we need to divide 1 plus r. In the year 2, we need to divide 1 plus r, all of that at exponent 2. Okay, this is a basic idea, probably really easy to understand here, but then we will need to apply that to a more realistic case. Imagine that you have a business in which you don't need to invest any money, and you know that the only resource that you will need to invest is your time and your effort, and you know that with this business you will get $100 in the first year, $100 in the second, and $100 in the third year. You are here in the year 0, so probably you are thinking in this time that probably it would be a really good idea to best this business to other colleague, to other friend. So you will need to have you will need to know what is the intrinsic value of this business in order to know what is the number that you will ask for your business. Okay, so the only thing that you need to do here is to take back all these numbers, because this is the number that you are expecting for this business. So you are estimating here the intrinsic value, and the intrinsic value in this case would be something like this: 1 plus r in the first year, 100 over 1 plus r in the second year. Okay, and then we will have something like 1 plus r in the third year. Okay, this is your intrinsic value. Okay, this is your intrinsic value. I think that it is really pretty easy to understand, fairly easy. Now that you know how to make the calculation here, I mean, this is the most important structure, because this is what we do when we are calculating the intrinsic value of many companies using the DCF. But in order to understand, to have a better understanding of the main idea of this construction, we could imagine something like that. If we have the same business, imagine that we have the same business, and you know well that we will get the $100 in the first year. What happened if you want to put that money to work for you, as I have previously mentioned in most simple case? Okay, now you know that this 100 will be invested in other opportunities, and you know that you will get the average return of R. Okay, so in the second year, this money will get something like this. But of course, you are working in your current business, and you will get your second cash flow in this case. We could assume that this is revenues or cash flow, because we are assuming a really simplistic scenario, really simplistic assumption here, that there is no cost at all. Okay, just revenues, and all the revenues will be paid in cash. Okay, now you are here, and this is your first 100, which is getting a return. Okay, you are not reinvesting in this business, and then this in the third year, you will get that this business, I mean this money will have another return. Okay, we have another return here. Now, because, well, you are receiving in the first year your first $100, and this $100 will have a return in for 1 year, and then for another year. Okay, and at the end of the year 3, you will receive your third $100. So in the end, you will have at the end of the year 3 the following. Okay, 1 plus r at exponent 2, which is this, which is referred to the first 100, Then you will do the same in the second year. You will put your money to work for you in reinvesting in the same other opportunities, but you will get in this case 1 plus R and nothing more, because there is only one period here. Okay, and then you will have your $100 that you have received in the third year. There's no more time, because, well, we are in the third year as well. So this is your future value of your business. Okay, this is the future value of your business. It is not just that you should sum the cash flow. This is wrong, because we're taking into account here that the money has a cost over time. Okay, there is a cost here, which is the cost of opportunity. The cost of opportunity is those other opportunities that you have to reinvest that cash that you are earning right now, and you are putting in other opportunities. This is the main idea behind the calculation of the calculation of the intrinsic value using the DCF, the discounted cash flow. Okay, so this is the I hope that you really understand this. Okay, now the thing is that this is the future value of your business. Okay, this is the future value of your business. You are taking into account all the cash flow that you are receiving, and you are taking into account all the returns that you are getting. Once you're receiving, in each case, you are receiving your revenues or your payments or your cash flows, and then you are reinvesting in other opportunities in the first year, and you're investing in the second year. Okay, and as a result of those returns, this is the future value. This is you are, well, I don't know if I should say that you are maximizing the value of your business, but that's what you're doing here. Well, this is the future value, and you will need to take back all that money to the present value, because we are here. Okay, now in order for doing so, you just will need to take the future value. Okay, future value, and divide by, if you are in year 3, you only will need to divide by at the exponent 3. Okay, in that way, this is the present value. And look what we are getting here. I mean, look at we are getting, just making arrangements here. You will get something like that, something like this, plus 100, 1 plus R, 1 plus R, and you get this. Okay, you get this, and so this is 2. So this is, you can sell, you have 1 here, you can sell, and you can sell, you have 2 here, and you have the same formula here. Okay, this is intrinsic value. Okay, so you can get an idea of what is the main idea behind these calculations of the present value. Is this that you are taking the money in each cash in each year, and you are reinvesting in each year to other opportunities, and you are trying to take advantage of the compounding effect. Okay, the compounding effect is just that the same money is earning a return year by year. In this case, the first year, the first 100 is getting a return 1 plus R at exponent 2, because it is reinvested in order to take advantage, in order to compound for 1 or 2 years of returns. And in the second year, you just have one period to take advantage of the return, and in that way. Okay, so this is the main idea behind the calculation of the present value of the DCF using the present value and future values. Okay, well, I hope that this can be understood fully. Okay, but then what is the reality here? The reality here is that when we are trying to calculate an intrinsic value of a high quality company, we have the free cash flow. We need to take into account the free cash flow. Okay, then we have this. Okay, so in this case, we will need something like to know that this one. Okay, in the first year, I mean, we are making projections for the next 10 years of the company, and this is the past. Okay, this is the past. It is supposed that in the past the company has demonstrated to be really stable, really consistent in its delivery of free cash flow. Then we have this, the free cash flow, and F10. Okay, now the thing is that it is a common practice here. It is a common practice to have this, to take to project the free cash flow for the next year. Okay, suppose that we are here and you are projecting these years, so we could arrange this in order to consider a certain growth in the free cash flows. Okay, probably it would be better if we consider this, and if we consider this, that would be the growth of the free cash flow that we are estimating for the next 10 years. Okay, so the thing is that something is missing here. The fact that the high quality companies that we used to evaluate, they will not only last for the next 10 years, they will continuously operate beyond the next 10 years. So it is important to consider this the year 11, year 12, and so forth to the infinite. Okay, now the first thing that we can do is to calculate the present value, okay, of all these terms. Okay, this is the first step that we need to do when we are trying to make a calculation of the calculation of the intrinsic value here. Now this is the present value of the first 10 years. Now we need to deal now with the perpetuity. How we can deal with this? Okay, there is a formula which is called the perpetuity, which means that you are considering something like this. Okay, this is a formula that considers that you are taking a free cash flow is equal in a indefinite sequence. Okay, of course we can reach from here to get here, but I think that the purpose of this video is not to make demonstrations of certain formulas, but this is the main idea. But in the real life, we need something like this. Okay, because the free cash flow of the high quality companies tend to grow over the time. Okay, so fortunately there is a way to calculate this. Okay, if we incorporate the G, the formula turns into this. Okay, where the R is higher than G, just a mathematical requirement here. Okay, so the thing is that right now we could apply this formula to the perpetuity, and in that way we will avoid to use all a future to make all these indefinite sequence. And okay, so this is pretty good to apply here in order to calculate our intrinsic value here. So in order to do that, we will follow first the sequence. Okay, in this case would be F1, 1 plus G at a 10, okay? And then we could continue with the F1, 1 plus G. It should be 11, but it is a standard practice to consider a G for the 1 G for the next 10 years and another G which is lower, which should be lower than the G of the next 10 years in the case of perpetuity. I mean, again, if we are making projections here, we will need something like this. I mean, we're assuming that for example, for the next 10 years, we could assume that we are growing at a 3%. And in the case of the perpetuity, we could consider that we are growing at a 1% or a 0.5%. This is the way in which we could be conservative in our assumptions, okay? Then probably this is the time to consider what would be the assumptions that we are making to construct this formula here, okay? The first is the returns, the discounted rate, which is the cost of opportunities. Then we will take this growth for the next 10 years, and then we will have this growth for the perpetuity. Okay. Now, something important here would be, I mean, you pay attention in here, I mean, because most people are lost on here. Look, under this circumstance, if we just focus just in the perpetuity, we could consider that this is our year 0, and this is our year 1, this is our year 2, okay? Suppose that the 0 is above the year 10th, okay? Now, in order to apply this formula, we could pass here, okay? This one, okay, here, okay? In the year 0, okay? 1, 2, 10, okay, 10. Now here we could have something like this, okay, 1 plus G at a 10, okay. We just are taking our formula from the first term, okay. We are considering that this is our first term for this indefinite sequence. And given the fact that we need to apply this is the cost of opportunity, we are considering the same as usual, okay? And we are considering another another G. Of course, we can assume that this is the same G. I wouldn't have any problem to consider that this is 11, then the 12, the 13, and so forth. But the common practice is rather different. Okay, you will understand when we apply this kind of situations in a real case. Okay. Now this is the year 0. I mean, this is our year 0 because we are calculating the intrinsic value, the present value of this sequence, which is the perpetuity. Okay, all these sequence will get a present value, which is this, but should be located in this year, in the year 10. Okay, but then we have to make another calculate another present value, because we are in reality we are in the year 10. So we need, and we are here, so we need to calculate the present value of that term, okay, which is 1 plus R at a 10 by F1 1 plus G at a 10 R plus G. Okay, now the thing is that we are almost finishing. You realize that we are calculating, in order to take into account all these future sequence of the perpetuity, we are really calculating the present value first. The present value of all this sequence is this, and then we are taking another present value of the same term to the year 0, which is this. Okay. then yeah, we are almost finishing this formula. So I will try to make this in order for you to avoid confusion here. Okay, then we will need to add something. I mean, if the free cash flow is calculated, is because is obtained by the company, is because the company is using all its tangible assets, tangible intangible assets, but there's one asset that is not considering in the production of the free cash flow, which is the cash. The cash is just a money parked by the company in a saving accounts. It's not working within the company. Okay, so we need to include the cash because according to the one of the main assumptions of this calculation is that you will acquire the 100% of the shares of the company. I mean, we are acquiring the company fully. So, and when we are doing that, we will get access to this cash. Okay, and then we need to subtract just the debt here, the debt. Okay, the debt, which is because, well, we use debt, the company used debt in order to, I don't know, to buy certain assets that will help the company to produce all these cash flows. Okay, but we need to but the company needs to be able to pay back all that debt. Okay, and that would be from the value that the company is generating right now with this intrinsic value. Okay, now the only thing that we need to do is to divide by the outstanding shares. Okay, outstanding shares. Now once we have our intrinsic value calculated here, we will need to compare with the stock price. Okay, and once we have this, we could calculate what is the margin of safety, a concept really used and created by Benjamin Graham. Benjamin Graham is the father of the value investing philosophy. He wrote the books of the security analysis and the intelligent investor. Okay, well, this is the margin of safety calculated in terms of percentage. It could be 20%, it could be 30%, and so on. Benjamin Graham used to like 50% at least of margin of safety. Okay. So what is the important point here? I mean, we need to be really conservative because this intrinsic value is the reference that we will take, that any value investor will take in order to make an investment. Okay, so it is extremely important how that value investor make that calculation. And something really important here is about this margin of safety is that really the margin of safety starts here. What are your assumptions? If you are conservative enough, you will try to push this intrinsic value to go down. But if you are extremely optimistic about the prospects of the company, if you expect so much growth in its free cash flow, so much growth in the perpetuity, and you consider that the discount rate should be really low, your cost of opportunity is low, you will push up this value, and you will tend to think that there is a huge margin of safety respect to the current stock price, which is something that is not recommendable to do. Okay. Now, I hope that you get the best idea because, well, I will use this methodology of calculation in later videos. So this is just a video that will show to you what are the foundations of how in this channel we will calculate the intrinsic value of certain companies. Okay. Now we need to pass for another stage here, and it is because the free cash flow, which is probably the most important ingredient in this formula, we need to understand what it is. Really, it is the cash flow from operations minus the capex, capital expenditures. You see that this kind of figure you will encounter in the cash flow statements. if you remember what are the financial statements, you have the balance sheet, you have the income statement, and you have the cash flow from the cash flow statements. Okay, I was just saying in a wrong way. Okay. Now in the cash flow statement, you will have the cash flow from operations, the cash flow for investing, and the cash flow for financing. Okay. Now in the cash flow for operations, you will find all the inflows and outflows of the operations of the company. Okay, all the revenues or the accounts receivables. I don't know, all the situations of the inflows and outflows that are due to the operations of the company. You will find it here, and then you will have the cash flow from investing, which is all the investment that the company has made in the last year, particularly if we are talking about in annual financial statements. You will find here the upgrade of certain equipment, certain properties, certain intangibles related to patents, related to rights, and so forth. And in the case of the cash for financing, is basically how the company is funding its operations. Probably the company could use the money from banks, the money from issuing corporate bonds, convertible bonds, you name it. There are several sources of funding that are included in this part. Once you have all these three parts, you will have a net position of the market, which will be combined with the accumulated position of the company from previous years, and then you will have your cash on hand here at the end. This cash on hand is what it goes to the balance sheet. Okay, to the balance sheet directly. Okay. Now what is important here, I was forgetting this, the capital expenditures. Well, the capital expenditures, you will find it in here. Okay, in the cash flow for investing. Here when we are upgrading certain software or upgrading certain infrastructure or property in order for the company to operate as usual, that would be the capital expenditures here. Okay. Now in order for you to understand better this, the cash flow from operation is just the net income. In order to because the important thing here is to get a strong idea of what we are talking about. Then we have the non-cash items, and then we will have the difference of working capital. This difference of working capital refers to the difference between the current year and the previous year. Okay. Now what we are doing here is that we are transforming really, this part, the cash flow statement is a transformation of the income statement. In the income statement you will have, you will understand it better in this one. If you have the net income is equal to the sales minus the cost of goods minus the depreciation minus the amortization minus the interest expenses and so forth. And then you will find in your cash flow statements, you will find that there are many other non-cash items. Among them, the main ones are the depreciation and amortization. There are other like the stock-based compensations and so forth. But in order for us to understand it better, is just because we are adding this, what we are doing really is to eliminate this depreciation and amortization in order to have only what is really cash, almost in payments, almost in revenues, but only cash, the cash that the company is receiving and the cash that the company is paying. This is what matters in this part. So we need to eliminate we need to eliminate all these non-cash items. And then in the case of the sales, you know that when we are selling something, when the company is selling something, not all is paid in cash. A part is paid in accounts receivables. Okay, the same thing happened with the cost of goods. So this part of non-cash is incorporated in this term, okay, which is the accounts receivables from the current year and the account receivables from the previous year. Okay. This refers to the sales, and this refers to the cost of goods is accounts payables. The same thing happened. Okay. And in this term is always incorporated the inventories, okay, which is associated with the cost of goods in a way. Now, probably you don't understand, but the working capital really is the current assets minus the current liability. Okay, so what we're saying here when we are applying this triangle is the difference, and the difference is between the current accounts from the year T minus the current liabilities of the year T, okay, minus the current accounts of the year T minus 1. That's what we are talking about, the difference of working capital, and it is incorporated in this way, okay, in order for you to understand it better. Now, in order to picture this, because here with these differences, we will get the cash that we are looking for. For example, what happened if here you are including here the part of the sales that were paid in cash, but here we are dealing with the other part which is not paid in cash. But with this difference, we are getting that what would be the cash that would mean for the company to increase or to decrease the free cash flow. You will see this in an example. What happened, for example, if you have your account receivable in the previous year of 2, and you have an account receivable of the year T of the current year of 4. Okay, that means that your account receivable has increased, which means that in a context in which we are experiencing a growth in sales, that means that great part of those sales are not paid in cash. So that means that you are receiving accounts receivables, and it's a common practice that some important clients just pay you with account receivable, which means that the clients will pay you in 3, 4, 5, or even 6 months. Okay, so that of course is not good for the company, because the company has previously assumed cost to produce all those products and services. So your free cash flow will tend to decrease. Okay, that situation would influence in decrease this term, in decrease this term, and in decrease this term. Okay, but what happens if the reverse happens? If your account receivable was 4, and then in this year it was reduced to 2. That means in a context in which the company is growing its sales, that means that the majority of the sales is paid in cash, and the part that is paid in accounts receivables was reduced, at least in this case, significantly. So that means that you are receiving more cash, which means that you will increase your free cash flow. What happened in the case of the account payables? If you have 2 here and 4 here, this is more related to how the company is dealing with its suppliers, and in this case you have that your account payables have increased in the current year respect to the previous year, which means that your suppliers are giving facilities to our company. The company doesn't have to pay cash to them right now, so much cash. Probably the company will have to pay cash, but the suppliers is giving The suppliers are giving the possibility to the company to delay that payments for the next 2 or 3 or 4 months. Okay, that is something good because that will influence, that will push up our free cash flow. Okay, if in the case, if something, if the reverse happen, I mean, if we have less account payables, that means that the suppliers are not giving us enough possibilities, so we have to pay more cash right now. Okay, so that contributes, that means that more money is getting out of the company. Okay, paying in order to pay for those suppliers. So that would be a less free cash flow. Okay, in that possibility. In the case of the inventories here, in the case of the inventories, what happened if the inventories has been reduced to a half in the current year? It means that in the context in which we are growing sales, that means that the most of our inventories has been already sold, which is something good. Okay. That of course means that there would be more free cash flow for us. If the reverse happen, more inventories, that means that we are afford so much cost to produce all those products in inventory, but we are not receiving any cash for them right now. So that's of course something that weaken our position in cash. Okay, that push down our free cash flow. So the combined effect of these situations is collected in this term. Now, in order for us to understand how the moat and the competitive advantages could influence in these terms, we could imagine that the best scenario could be in which the company is holding lower account receivable, lower levels of account receivable, higher levels of accounts payables, and lower levels of inventories. Okay. So if the company has certain power to deal with its customers, because the customers considering that the products and services offered by the company are really competitive, are really good, and those services and products are extremely necessary for the clients. So I mean, I think that in this scenario, the company will have the power to negotiate, the power to negotiate, and in that way the company could push down its account receivables. Okay, that which of course will reinforce its free cash flow. Okay, the same could be said by the case of the account payables, in which the company would need to have the power to deal with its suppliers. Okay, and in this one, in the case of the inventories, well, it's more related in the strategy of the company to have a long-term defined strategy in order to offer products that are actually important and needed by its customers, and in that way avoid so much inventories. So this is this. I hope that you really understand this, and in order for you to have a better idea, a better picture, how the free cash flow really could contribute to delivering value to the shareholders. In this case, of course, the free cash flow is the source of when the company maximizes its free cash flow. It means that the company will have more money to pay dividends, more money to reinvest in its own business, and of course to make a payback of its own shares. Okay, which we know that could contribute to boost our shares in the long term. So that could be subject of another video, but of course it is important how this term is important to deliver long-term value for the shareholders, and that's why probably most likely why investors like Warren Buffett or Charlie Munger, we consider the free cash flow as owner earnings. I mean, because that is the source to generate long-term value for the shareholders. Now I think that this is we could pass to the third stage in this video, and in order to explain something that I consider that it's important. I mean, I didn't talk so much about the cost of opportunity, the rate, the discount rate, and that is, well, there are other YouTube channels and even in the business schools, in the universities, that it is associated with a weighted average cost of capital, okay? And it's important because you will understand why I don't use it, okay? This is my humble perspective. I'm not saying that you shouldn't practice it. I'm just saying that this will be the reason why I don't use these kind of constructions. Well, in order to understand it in a better way, we will need to construct the formula. This is the required return by the shareholders. This is the cost of debt. This is the weight of the equity plus D, okay? And this is, well, this is the multiplication, this is plus, and this is another weight, okay, another weight, and this is the we need to consider here the benefits of the taxes, okay, because this is the cost of debt, okay. Now there are people, of course, who feel comfortable using the weighted average cost of capital as a rate of discount, okay, in their free cash flow, in their construction of the intrinsic value using the DCF. The reason I'm not considering this because of this is the required return by the shareholders, and so in order to calculate the required according to this framework is the risk-free asset, which could be the 10-year bonds of the treasury, 30-year bond of the treasury, and so forth. So here we have the beta here, and this is the return of the market, and this is the free risk asset again. Now the problem with this is this beta. Assuming that we are assessing Apple, okay, so we will need really the beta of Apple, okay. So what is the beta? The beta is associated with the volatility. So the higher volatility is here, you will demand, as a shareholder, you will demand a higher return, okay. So what is the volatility? What is the beta? Beta is really the contribution of the volatility of the stock price of Apple to the volatility of a universal portfolio. Universal portfolio could be considered an S&P 500, a Wilshire 3000, Wilshire 6000, but the thing is that the beta is more related to the volatility, okay. And so why, in order for you to understand this, why the higher the beta, the higher the return that you need to require, is because there is an assumption underlying here that it is the volatility is equal to the risk, okay. According to this framework or these formulas, the volatility is equal to the risk, okay, which is something that is not necessarily true. According to the value investment philosophy, the real risk for a value investor is the loss of permanent capital, which is more related to the business model that you are picking in a company. If the business model of a company is weak or is facing a fierce competition in its respective industry, if the business model of the company do not have any sort of competitive advantages, that is a real risk, okay. So for us, this is something that is not fulfilled, okay. The volatility is not the same as risk, and the reason probably you will understand in the chart. If you have in a company, a good company with solid competitive advantages here, you will see certain volatility, so it's unavoidable, and most likely you will see a intrinsic value like this. An intrinsic value that really grows over time, okay. So the volatility allow a value investor to find the price at these points. Given the fact that this is the intrinsic value, you will have this upside. Okay, you will have this upside and this benefit. If this is a compounder, of course, some people confuse just because they consider that the company reached its intrinsic value in this point, they sell. But I consider that if the company really is a compounder, you will have a benefit like this if you hold for several years. Okay. Now the thing is that if you see, the volatility really is not the risk here. Any value investor should embrace the volatility here. Okay, because that's what the volatility is. Thanks to the volatility, you will give those opportunities here, those opportunities to get higher returns over the long term. Okay, high returns over the long term. So I hope that you really have a better idea, because here in this channel I won't use these kind of constructions. Okay, and this is the rationale behind it. Today we are in a current scenario in which there is the possibility of increase the interest rates. Okay, the Federal Reserve has said that the interest rate could be increased in this year at least 3 or 4 times, and that could continue in the year 2023 as well. So we need to make sure how this situation would influence in our calculations, in our methodology, because that's the most important thing here to understand. If we have this, okay, and this indefinite, okay, this is intrinsic value. So if the interest rates are rising, that of course could influence in the rate of discount, and that could go down our intrinsic value. That's probably one of the reasons why several companies are experiencing their decline of 40 or 30, 40, 50% right now, and some institutional investors use these kind of calculations. But then there are other way to influence in our intrinsic value. Surely, when you are increasing your interest rates, it means that the cost of funding for the banks will be rising as well. So the banks will have to rise interest rates for long-term loans, for middle-term loans, for financing working capital, which is extremely important for many small companies, middle-sized companies, or even for big corporations. So that increase in the interest rate could represent a cost, and that could slow down or could stop some projects that most companies were planning to make in the future. In the case, for example, of the consumer loans, if the interest rates are rising, most people will decelerate their pace of consumption here in order to avoid the higher cost that they will have to afford at the end of the month, at the end of the year. And in that way, most companies will face lower expectations for their free cash flow in the future, and that's of course another push to go down of their intrinsic value. But in the case of most high quality companies, those high quality companies of course could see that their costs are increasing because of the inflation rates. Given the fact that in the case of the US, the inflation rate is 6 or 7%, and of course the Federal Reserve need to decrease that inflation rate to 2%, which is the standard annual target. But given the fact that the companies could see this kind of situations, increasing of the interest rates, increasing of the cost of inputs, they have the possibility to rise their prices. Okay, and in that way they could push up their free cash flow in order to be more resilient, more resistant to any sort of these possibilities or these recessions or these economic turmoils. These high quality companies really have the possibility to resist in these situations, these difficult situations. That's important to notice here, why these kind of companies should be really measured. And I mean, it is important to identify the intangibles of these companies in order to know if those companies have solid competitive advantages, and in that way they would have the power to set higher prices in order to be protected in difficult scenarios, in difficult situations. So, and of course, our model of the intrinsic value of the DCF really help us to understand these kind of situations. So I hope that really you have enjoyed this video. Please put a button of like in order to help this channel, and put a comment. I mean, I like to receive feedback from you, and I will answer as soon as possible. And consider to subscribe to this channel in order for me, give me the incentives to continuously delivering more and more knowledge about the investment, about my humble experience. And most likely in the next video I will talk about the intrinsic value of Apple, and we will find out if the company is really expensive or not so much expensive as many people think. Okay, so I hope to see you in the next video. Peace.